Investing should be easy, right? For most people, though, the process of investing can be daunting, and savvy investing, impossible. Here at Alliant Retirement and Investment Services, we don't think it should be that way. So we asked two of our financial consultants, Krystian and Tom to share their advice with you. They're here to walk us through the fundamentals of investing so we can make informed and better decisions with our money and what we need to do to prepare for the road ahead. Hello, everyone. Welcome back to Invest Savvy and part 2 of our end-of-year planning episodes. In part 1, we started our conversation with the subjects of taxes, retirement, investments, and insurance, and the deadlines we need to watch for as we approach year-end. We can wait right here while you catch up on the episode. Oh, now that you're back, let's dive a little deeper into more of the personal milestones that may have happened this year. These might be related to age, health changes that might have affected your family, that sort of thing. Let's start with those age milestones that we should be considering here at the end of the year. Tom, can you take us through that?
Yes. One of the first milestones that we're going to look at is age 50. And at age 50, we talk about something that we've approached on our last episode, which is the catch-up contribution. The catch-up contribution is going to apply to IRA account contributions, as well as qualified retirement plans, or what we call a 401k plan. So for an IRA, the catch-up contribution over age 50 is an additional $1,000 per person, bringing the total contribution up to $7,500, and that's up from $6,500 in 2022. Also, new for 2023, the annual contribution limit for 401ks, 403bs, most 457 plans, and governmental thrift savings plans, that's $22,500, up from $20,500 in 2022. So the catch-up contribution limit for employees age 50 and over who participate in these plans is increasing to $7,500, up from $6,500. So your total 2023 401k contribution can be $30,000.
And the next milestone is age 55, where someone with a participation in a 401k or 403b can start taking their distribution without any penalty if they leave their employer in the year that they turn 55. So you can continue to take withdrawals penalty-free even if you get another job. But keep in mind that these withdrawals are subject to income tax and that the rule only allows the most recent employer plan, not a previous retirement fund or IRA.
All right, and 59 and a half?
59 and a half is an age where you could take penalty-free distributions from your IRA accounts. However, the withdrawals are still subject to income tax.
So 62 is when you start receiving benefits from Social Security, but you can apply as early as 61 years and 9 months if you'd like to be early. But this early filing comes at a cost, which is a permanent reduction in the amount that you will receive by as much as 30% versus full retirement age of 66 or 67. Then there is a choice of waiting even longer to get a bigger check, filing for benefits as late as age 70. You will save on taxes, but the cash inflows will be delayed. So your reward is an 8% increase in benefits per year up until age 70.
From there, we're going to look at age 65. And at 65, we're going to be concerned with healthcare plans and Medicare. So when you turn 65, you have 3 months before your birthday, the month of your birthday, and 3 months after your birthday to sign up for Medicare. It's much more detailed than that. And we have a specific podcast episode for an overview on Medicare Planning 101.
That would be episode 9. Take a listen for more information. Are there any more milestone birthdays or half birthdays?
The next one is age 72, where you need to start withdrawing money from your IRAs and 401ks if you're no longer working there. It's possible that the RMD age will increase in the future, but today it is 72. If you are still working for your employer, again, you don't need to take out funds from your 401k, but you still need to take it out of any IRAs or previous employer 401ks.
All right, let's pivot to health. What should we plan for now for our health and our family's health?
Well, first, you want to take this opportunity to review your employer's health insurance plan. You might still be in what's called the open enrollment period now and have the ability to make changes to your benefits with your employer. Not only do you want to look and make sure you have the correct medical coverage for your situation, but you want to look at other benefits that are offered like disability, insurance, life insurance, and there might be an offering for long-term care coverage that would be important to your overall financial planning.
And if there's any changes to the family, any newborns, anyone who has passed away, you'll want to factor in those updates into your plan enrollment options. Benefits and costs are always being reviewed by HR departments, so keep an eye out for what makes sense and how to get the best value for your family.
One thing that recently changed, a child could stay on your healthcare plan until they are age 26. Previously, when they were no longer a dependent or a full-time student, they would have to leave your medical plan. But now it's 26. You could even compare benefits within your family and see which is more advantageous. With this rule, young adults age 26 and under can stay on their parents' health insurance even if they have started or finished school, are no longer claimed as a dependent, are married, adopt or have a child, or if they turn down their employer-sponsored health insurance.
If you have a health savings account, an HSA, you want to review how much you've contributed so far and whether or not you can top that up. The limit for a family in 2022 is $7,300, and for an individual, it's $3,650, basically half. If you are above 55 years of age, you can add an extra $1,000 as a catch-up contribution. The nice thing about an HSA is that you can carry the balance over from year to year. You don't have to use it up in the year that you contribute. And you can also invest in a portfolio if your balance is high enough, depending on your provider.
I have a flexible spending account for my son's after-school care. I think there's a carryover at the beginning of the year to spend that down. Is that typical?
Yes, whereas the HSA account is something that you could build and grow over time, like Krystian said, you could even invest those dollars. They could have potential market gains over time, and that's going to add up. And you could look at that as possible long-term care planning as well. Now, here's a little known secret. You can move funds from an IRA retirement account to an HSA only if you're eligible to contribute to your HSA. In other words, you need to do the transfer while you're covered by a high deductible health plan and are otherwise eligible to have an HSA account. You can only roll over funds from an IRA to an HSA once during your lifetime, and the maximum amount you can roll over is the same as your annual HSA contribution limit for that year. So what you have done here is taken a tax-deferred investment and make it a tax-free investment for medical expense purposes.
There's not a penalty later?
No. However, you can only do this one time. A testing period requires you to remain eligible for the HSA for at least 12 months after the rollover, and you must first roll funds into an IRA before moving them from another type of retirement account, such as a 401k or 457 plan.
And then, always with health, you want to keep Medicare in mind. And if you need assistance with that or tips, then take a listen to our episode 9. All right, let's move on to changes that might have happened this year, even going back to January. Here we are, the end of the year. We should probably be taking action on some of those items, even if we forgot about them. What kinds of changes should we keep in mind?
So the first one is whether or not you've sold your property, your vacation, business property, keeping track of all those upgrades and any expenses. For your principal residence, if you've lived there 2 out of the last 5 years and you sell the property, you're entitled to a deduction for a single person of $250,000 versus any gain. And if you file married jointly, then you have a $500,000 deduction where you don't have to pay any tax on that. Anything over and above is a long-term capital gain.
Moving in general, you should make sure your addresses are updated everywhere. Krystian, you went through a move. This is your reminder.
Hey, yes, indeed. Thanks. Also, if you refinanced your house, then you want to get an estimate of any changes in deductions, plus factor in state and local tax deductions, which are limited to $10,000 currently on your federal return. You also can deduct mortgage interest for mortgages up to $750,000. It used to be on the first $1 million, but was reduced in 2022. If you open up a home equity line of credit, you can generally deduct the interest if you use the money to spend on improving or repairing the property that is secured by the HELOC. Again, always check with your CPA for any tax advice.
You should also ask yourself, did I transfer any assets this year? Did I make any major financial changes throughout the year? And I think what that's going to boil down to is, am I going to have to pay tax on the transfer of that asset? This means you have to come up with a cost basis for what you paid for the asset versus what you sold it for. So you want to make sure now that you have the leisure of time on your side that you're able to come up with those cost basis numbers before having to scramble for them in April. Additionally, another major transfer that we've talked about through the year is a Roth conversion. If you made that type of transfer, you want to do a quick calculation to see if there were any quarterly taxes due this year. You still have a chance to make a tax payment, so there's no penalties.
We did a deep dive into Roth conversions in episode 5. Check that out if you'd like to know more. This current episode being our 11th, we have a library of topics built to refer you to.
Now, another thing to look at, if you have not done the transfer of that Roth conversion, is you still have all the way up to December 31st to make that transfer from a traditional IRA to a Roth IRA under a conversion. Putting on my compliance hat here, there are considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of the conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution in the year you convert, you must also do so before converting to a Roth IRA. Now, the good news is there's a 5-year holding period for a Roth IRA. Even if you did that transfer on December 31st, that counts for the whole year. You will now have 1 out of the 5 years completed. And if you're over 59 and a half, you don't have to worry about the 5-year rule.
Another significant change would be leaving a job, whether through your own choosing or a layoff. What are some things to think about?
I think number 1 is the 401k. Did I leave my 401k behind at the previous employer? There's an opportunity to review that for some reallocations. Number 2 is, did I get the new 401k set up? I know there's a lot of things that go on with a job change, and sometimes you overlook that. It's also a good time to decide if you want to contribute to the Roth 401k or the Roth IRA, which we can help with as well. The third part I would mention is benefits. When you change jobs, you're in what's called a qualifying period. A qualifying event, which for health plan purposes or benefit purposes is marriage, death, divorce, or a new job. This will allow you to choose new benefits. Maybe you can coordinate them with a spouse to make sure you're getting the best plan for yourself.
Lots of family-related changes to think about. So a newly married couple will want to look at their tax status and think about whether or not they want to file jointly. They will also want to update each other's beneficiaries and consider whether or not the spouse is going to be the new beneficiary of their retirement accounts and any life insurance policies. A lot of times people list their siblings or their parents as beneficiaries before getting married. So you'll want to review and update those accounts accordingly. If someone passed away, likewise, you'll need to take that person off as a beneficiary and update to the new beneficiary, especially for those older accounts. Beneficiary designations help you to avoid probate, but only if live beneficiaries are listed.
Probate. That's a plug to listen to our estate planning episodes, where I learned probate is not something I want my loved ones to deal with. And we go deeper into trusts in that episode, which we'll talk about in a minute. Now, I'll just mention a little cautionary tale here. A friend of mine forgot to update his dependents on his health insurance during open enrollment, essentially forgetting that his lovely wife gave birth to a child earlier that year. So don't forget to add those new children to your accounts.
They were probably sleep deprived.
Exactly.
And don't forget to update beneficiaries after a divorce as well. If there's a new marriage in the family, it might be a situation of blended families, and it's a good time to do a beneficiary review. Maybe also a good time to revisit establishing a trust just to make sure your assets are distributed correctly.
How about illness in the family or a parent or spouse who has moved to assisted living?
If a parent or anyone in the family is moving to an assisted living facility, or if they are getting long term care assistance with a nurse coming to the home, whatever it is, you want to keep track of all those expenses. If you have long term care insurance, submit those receipts or complete the paperwork for your indemnity policy, which pays you monthly once you qualify for long term care. And start to consider all the decisions that go into that process. For planning ahead, know which facility is going to be best for your family member, whether it's close by or if there are any special needs services further away. Understand the costs and cash flows required, whether from your savings account or if you need to liquidate some investments, including real estate. The timing of those sales can be important.
Let's say I received a monetary gift or inheritance at some point during the year. What should I do about that here at the end of the year?
I'd say the first thing to do is just make sure that all tax liabilities have been settled. Make sure, if you have to pay any additional tax amounts, that you kind of set that aside from the overall inheritance or gift that you might be receiving. The second thing to look at is with an inheritance, generally a lot of things happen at one time, and it's a lot of money that came into the situation. You don't need to make immediate rash decisions with a potentially large amount of money that just came to you. It's best to take your time and make sure you really do the correct financial planning to see how it all fits in, either for your short-term needs or your long-term goals. So take the time to do the proper planning.
If there's a gifting strategy in place for kids or grandkids, review if you want to continue that this year. The limit for 2022 is $16,000 and going up to $17,000 next year. You can move those funds out of your estate into the hands of either your family members or your friends. There's no limit on the number of gifts that you can give others, but you're limited to a dollar value per recipient. And a husband and wife are each entitled to their own gift. So with maybe a few children, some grandchildren, those dollars add up really quickly. Also, the sooner you do it, the more time you have to gift in the future to reduce your taxable estate.
Okay, Tom, as we wrap up our 2 episodes on year-end planning, I realized we haven't talked about 529 college savings plans. Any changes or deadlines to keep in mind with these programs?
Sure. So saving for college. Now, in most states, you should contribute to your 529 college savings plan by the end of the year to maximize any state tax breaks associated with these contributions. Now, 529 college savings plans don't have a set individual annual contribution limit like an IRA or a 401k plan. Instead, the annual contribution limits vary from state to state. It's also important to keep in mind that contributions to a 529 plan are treated as a gift for federal income tax purposes. Now, as Krystian just mentioned, in 2022, under the gift tax exclusion rules, you can contribute up to $16,000 tax-free per donor. In 2023, that number is increasing to $17,000. However, gifts over these limits must be reported on a federal gift tax return. Now, that doesn't necessarily mean that you'll be subject to tax on your gift because the lifetime federal gift tax exemption is so high. Now, having 2 kids in college myself, I can honestly say it is best to start saving early and often. If funds in a 529 plan are not used completely by one child, you can name a new beneficiary and pay for their higher education costs as well.
And some states do offer a state income tax deduction up to a certain amount. So you want to check the state that you reside, whether or not those benefits apply to you. Prior to investing in a 529 plan, investors should consider whether the investor's or designated beneficiary's home state offers any state tax or other state benefits, such as financial aid, scholarships, protection from creditors that are only available for investments in such state's qualified tuition program.
Thinking back to taxes, it's probably a good time to start thinking about our charitable contributions for the year. Krystian, will you talk about that?
If you've contributed to charities in the past or would like to get started, there are 2 ways to do that. You can do it individually per charity. You want to make sure to keep a record of all your receipts so that you can include those on your income tax form and get a deduction for it. You can also think about a trust if you plan to contribute a large amount of money and if you like to manage that a little more effectively. You can fund the trust in 1 year and pay your charities over time. Most people just give on an annual basis, but a trust is always an option.
We've covered a lot of ground in these 2 episodes and a lot to think about as we wrap up 2022. How about we give some savvy advice?
Don't put off till tomorrow what we can do today. December 31st is coming up quickly. So is December 31st, 2023 and 2024. So let's plan for them all together.
Planning for year end is not easy, but it is doable. Take the time to get organized. Ask for advice if you need it. It's a skill like any other. Build up your abilities over time.
And let's go through the finer points we talked about today, starting with retirement milestones.
Okay, I'm going to recap these ages. Age 50, you are now eligible for the catch-up contribution. Age 55, you could take a penalty-free withdrawal from a 401k plan that you have stopped working at. 59 and a half, no more 10% penalty for withdrawals from a retirement account. Age 62, you could start Social Security. Talk to us first. Age 65, welcome to Medicare eligibility. Age 67, Social Security full retirement age for most people. And at age 72, the dreaded required minimum distributions start from your retirement accounts.
Track your health expenses throughout the year. And if you are ready for Medicare, don't be late and incur a penalty.
Life changes, marriage, birth, death, divorce, job changes, or reaching one of those milestone ages I mentioned are all reasons to create or review your financial plan with your ARIS financial consultant.
Families will see major changes at least every 5 years. There are always financial dominoes for those life changes, so be as proactive as possible when it comes to taxes, savings, and investments.
Thank you both. From our Alliant and ARIS family, we wish everyone a happy holiday season. You can find episodes of Invest Savvy on Apple and Google Podcasts and all major platforms, or on our website. We invite you to follow us on Facebook and LinkedIn for new episodes and educational webinars and articles. Just search for ARIS, A-R-I-S, Alliant, to like and follow. Thank you for listening to Invest Savvy, advice you need to know. To learn more about our hosts, Krystian and Tom Davia, and the team at Alliant Retirement and Investment Services, please visit our website at ARIS.AlliantCreditUnion.com. If you have questions for our hosts, you can submit them through our website or email investment-services@AlliantCreditUnion.com. Krystian and Thomas Davia are registered representatives with, and securities and advisory services are offered through LPL Financial, a registered investment advisor and broker-dealer. Member FINRA SIPC, SIPC. Insurance products are offered through LPL or its licensed affiliates. Alliant Credit Union and Alliant Retirement and Investment Services, ARIS, are not registered as a broker-dealer or investment advisor. Registered representatives of LPL offer products and services using ARIS and may also be employees of Alliant Credit Union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of Alliant Credit Union or ARIS. Securities and insurance offered through LPL or its affiliates are not insured by NCUA or any other government agency, not credit union guaranteed, not credit union deposits or obligations, may lose value. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss. Neither LPL Financial nor its registered representatives offer tax or legal advice. Always consult a qualified tax advisor for information as to how taxes may affect your particular situation.